Hello, so it's a national religion for some, it's heresy for others. Today we look at house prices, and we don't consider house prices though through the window of the estate agents, but rather through the prism of an 18-year cycle, the 18-year cycle in property, one that was brought to public attention by economist Fred Harrison in his cult classic, Boom Bust, House Prices, Banking and the Depression of 2010. He published that book in 2005. So if you're into forecasting, that is quite some title. Now, as we are talking about cycles, before we start, let me issue my usual disclaimer, which is that cycles exist everywhere. The seasons of the year, night and day, the life cycles of plants and animals. In Shakespeare, the wheel has come full circle. They exist within our own bodies in the form of circadian rhythms. They sort of exist in markets too, in the sense that there are good times and bad times, bull markets and bear markets, 4-year presidential cycles, commodity super cycles, and more. Mining companies in particular go through clear cycles, perhaps phases is a better word, but from exploration and discovery through development and mine building to actual production. I'm a keen observer of hype cycles. How much of this story is known? How much more hype is left in the tin? Or is this story now tired? It's a good way of thinking about investments. And cycles also make for a very good copy. Kondratiev made his name peddling cycle stories. We like reading about cycles because they bring a veneer of certainty where in fact there is often none. Apologies for the wind, I haven't got my windjammer mic with me. But as that last point alludes, cycles, especially in markets, are also arbitrary, random and uncertain. It's easy for an academic to look back at history, find a pattern and declare it a cycle. When real life doesn't fit the model, you'll hear something like, oh, well, the war upset the cycle, or they printed loads of money so the cycle didn't work out properly, or whatever. Cycles in markets are not fixed and predictable in the same way as the days and weeks of the year. It's all a lot more random, and I think you've got the point. There's a certain amount of salt to pinch when it comes to cycles. Nevertheless, they are useful instruments, and I know some who swear by them, especially Harrison's, whose book was clearly brilliant in its forecast. Now, I can remember thinking, it was 2005, and I remember thinking about the housing market. It's nuts, it has to crash, and many felt the same way, including some of the brightest minds in the city, and a whole website, housepricecrash.co.uk, sprung up around the theme. And many of us were certain that the game was about to end. And then I stumbled across this brilliantly prophetic article by Fred Harrison in Money Week in 2005 saying, no, house prices aren't going to crash. We are 2 or 3 years from the top. This is in 2005, and he was right. And I was talking last week about house prices versus gold, and I was thinking about our distorted property market and the spectre of rising rates, and the thought occurred to me that we must be close to Harrison's next peak. And lo and behold, Merrin Somerset Webb interviewed him in the latest Money Week podcast. We've got the sirens going now. There's loads of police. I don't think I've done anything wrong. Anyway, Harrison's short answer was that in 2026, that's when we're going to see the top. We've got another 3 years, in other words. So let me quickly explain Harrison's thinking, how it works, and his idea, and it's more about land prices than it is house prices, though the two tend to rise and fall together, is that property tends to see 14 years of price growth followed by 14 years of decline, which breaks down into an 18-year cycle. So a full cycle might look something like this pattern that you're looking at here, and you can see the various phases of a cycle, all a bit, Harrison says that he can follow prices back some 200 years to find this clear 18-year cycle at play. And I don't have the data to cross-check that far, but I do have the data going back to 1951, courtesy of the Nationwide, and I can at least check that. And before World War II, property wasn't the overpriced monster that it is today. Home ownership was lower. It was beneath 25% most of the time. People rented, or most people rented from private landlords. Mortgages barely existed. They only really came in the 1930s and the 1950s. And so the cycle, even if visible, would not be as pronounced as it is in today's debt-ridden fiat era. And the top of the last cycle in the UK came in the third quarter of 2007. The average house price then fell from 183 grand roughly to 149 grand by the first quarter of 2009. And it didn't really get going again until 2012. So there's a clear 14-year decline. And there was definitely a buying window in that 2009 to 2012 period, but prices, especially in London, didn't fall by anything as much as many buyers were hoping for. And that's mostly because there were few forced sellers because interest rates were slashed. Had there been more forced sellers, then house prices would have come down by a lot more. Interesting little side point though, they fell by a lot more than 18% if you were a foreigner, because the pound lost a good 30% in the foreign exchange markets. That's measured mostly against the US dollar. So we go back 18 years from 2007, 2008, and we have the crash of 1989 to 1994. Prices peaked in the third quarter of 1989 at 63 grand before falling back to about 51 grand. And things stayed low. They didn't get going again until 1994, 95. And the pound also lost a lot of value in the forex markets then too. So it's working well so far, but we go back another 18 years to 1971, 1972, and the 70s were a horrible decade economically, but housing wasn't the worst place to be. Houses were a better hedge against inflation than cash, and between 1970 and 1973, house prices actually doubled. And then after 73, they just launched upwards. So we're going to declare that Harrison's cycle did not work here in the early 70s. I'd be interested to see why he says that. Is probably something to do with inflation. However, if you go back another 18 years to the early 1950s, house prices did see declines before the market took off in the second half of the decade and on into the 60s. So here are UK house prices since 1951, and I've marked the cycle peaks according to Harrison's model by red arrows. If we go back before World War II, I guess World War II upset the cycle, but there was a recession in the early 1920s, house prices fell, and then from about 26 to 39 until the war, they rose by a little, but by so little that the market would be better described as flat. They went from 620 average house price to 660 quid. Can you imagine 660 quid for a house? How much has money been debased? It's 275 grand now. So, all in all, I'm going to give Harrison's cycle an A-. It isn't perfect, but like many cycles, it is a useful guide and a scenario of higher prices going into 2025, 26, followed by a slump, is something I can very much envisage. So if you're looking to buy, start getting your finances in place now. If the slump is anything like 2008, you'll have to move pretty quickly. If it's like 1990 to 95, you will have plenty of time. I'll reevaluate in 2025, but my own experience, by the way, when it comes to buying your own home, this is different to investing in real estate, that's different, is that you have to move when the time is right for you to the place that best fits your circumstances. Trying to second guess the market can lead to unhappy outcomes. House prices, they only ever go up, and if they do go down, they won't come down as much as you want them to. And one final tip, period property keeps its value better than new build, or it appreciates more than new build. They're not building any more period property. Thanks very much for watching. Check out my Substack. It is great. There's lots of great content. Please subscribe to the YouTube channel. There are buttons all over the front here, and I'll be back with another video very soon. In the meantime, cheerio.